Hello and welcome to the How to Exit podcast. Today I'm here with Jeremy Harbour. Jeremy is a mergers and acquisitions expert, a mentor, an author, and still doing deals as we speak today. And actually, in full disclosure, he's one of my mentors. He's one of the only full courses I've taken, and are really active inside of his community. He built a beautiful community inside of the mergers and acquisition space. I want to welcome you and thank you for being on the show, Jeremy. What is your origin story? How did you get into buying and selling businesses? What got you started?
Yeah, look, I'm an entrepreneur through and through. I was the annoying kid at school that was always trying to sell people stuff. I was the son of a farmer. I grew up in the middle of nowhere in the south of England, and I could work on my dad's farm for £1 an hour. Let's say $1 an hour for your audience. So of course my imagination was constantly, how the hell do I make more than a buck an hour? And so I'd constantly be coming up with these schemes and ideas for generating more money. And I mean, I had a weekend market stall where I was selling watches and jewelry and a whole bunch of stuff. Anyway, I left school when I was 15. I didn't finish high school, and I pursued that business. It was actually generating quite a bit of cash at the time for a 15-year-old, and but that went spectacularly bust when I was 19 years old. I really overstretched myself. I took on a new premises, lots of staff, and I suddenly had this baptism of fire that not everything I touched turned to gold. In fact, in the little chat we were having just before this conversation, I was saying to you, the day I started in business was the day I felt I knew the most about business. You have this kind of arrogance about how easy everything is going to be until the fucking rubber hits the road, and then you realize where all all the obstacles are and how difficult it really is. But anyway, went bust when I was 19, and at that time it was the early 19 or mid 1990s. And I got into telecommunications. So mobile phones were miniaturizing, telecoms, every man and his dog had a telecommunications company, and it was really kind of booming. And I guess I rode the crest of that wave and started my own company. That grew quite quickly, as I think pretty much anybody that dabbled in that space at that time.
When you were advertising, dollar down, no money down type of deals in creative structure, I've been doing that in real estate for a long time. So, your first thought is it really possible?
Mm. Yeah, no, it's a very common disconnect that people have. And look, for me, it was necessity. And what is it they say? Necessity is the mother of invention. I didn't have a choice, and so I had to come up with a structure that worked. Now, obviously, that meant I probably walked away from a dozen deals that could have worked if I'd had the cash. But if you can create a deal that has asymmetric risk, so your downside is 100% protected. You could break even or you could make money. Well, you should take that bet every time. And I guess that's what I tried to create with the deal structures that I was doing. And they got more and more creative as I tried new things and grew a bit older. But absolutely, look, there's leverage buyouts, which is what most people understand a no money down deal to be, which is simply like taking a mortgage on a house. You borrow money to leverage an asset. Now, I don't like leveraging property particularly. I'm 47 years old, so I've been through about three housing crises in my life. And we're now in an era where the Fed is promising to raise interest rates. And historically, when that's happened, it often leads to a housing collapse. And the problem with a housing collapse is it tends to be a spiral, because as soon as the prices go down, it pushes a whole new band of people into negative equity. Those houses get repossessed. That drives the market a bit lower, and those will trigger a whole new rough, and it gets very bloody very quickly. Now, real estate, prices move in real estate pretty slowly. It's not a very liquid asset, and prices move pretty slowly. Small business is incredibly volatile. You lose two key customers, two key staff members, the business can change dramatically overnight. Likewise, you could win a customer or take a significant step forwards, or joint venture or something like that that could massively increase the value of the business. But nonetheless, if you're going to leverage, if you're going to borrow money, do you really want to be borrowing money against a highly volatile asset?
Why buy one as opposed to creating an idea and starting from scratch?
Yeah, so look, I think there's different reasons you can buy companies. So the one I just talked about was kind of a bolt-on. It was a way of expanding a business I already had without taking on additional staff members, investing in marketing, trying something new and risky. I could just add more customers to my customer base, and that's one kind of use for acquisitions, and a very viable one. What you're talking about is kind of the starting or buying a business instead of starting one. And I think this is also quite valuable because when you do start a business, you tend to find that first 3 years is really pushing the rock up the hill. You're developing the logo, the concept, the brand values, the website, finding employee number one, going out there and selling product yourself to try and get some, inertia. And that's pretty thankless. So, because when you value a business, you value it, for the shareholder value perspective. You tend to value it on its yield, what it can earn you. When you hear about price earnings ratio, it's a multiple of how much the business generates in income. Well, in that first 3 years, you don't generate a lot of income. You build a lot of foundations. And so, you only have a finite number of those 3 year stretches you can invest in things. And a lot of times, 95% apparently of times, those 3 years end in tears. They don't actually get you anywhere.
When you say small to medium, for a lot of acquisition entrepreneurs, a company generating 1.4, 1.3, you're under the radar of those institutional site buyers is still a life changing deal that can happen. That market. What I'm trying to get to, I guess, is that market of business owners where the private equity and the corporate buyers are not really diving into is a lot bigger than most people would expect.
It's most of the economy. Yeah. It's a really, really low. I mean, it's a pyramid, isn't it? With kind of Apple and Amazon at the top, and the further down you go in terms of scale, the wider it becomes. And so, there's a bottoming out level. I wouldn't buy a business doing less than 500,000 a year because it's pretty much a job for someone. It's not really a business. But there's a sweet spot in the kind of 1 to 5 million sort of space where the company is, delineated its roles and tasks within it. So it's separated sales from accounting, for example. And it's got, all of that stuff, mixed up, and there's not a lot of natural buyers for them.
So you're actively doing deals. I mean, you're like in the weeds doing the deals, and then you step outside of that occasionally to do mentoring and teach a course. I know you're coming to the United States in May or June, I think. So,
well, this is the thing. You'd know that better than me. I actually don't know when I'm there. So it's. I have a team so we have a Harbour Club community. So when I started the Harbour Club, which is the kind of the mentoring teaching side of things, I started it because I was being pestered all the time by people to come and work for them. So it was like, come and work for us and show us how you do what you do. Come and be a non-exec director, or come and be a consultant, help us buy a company. We want to buy a company, this kind of stuff. So I kept saying no to all these people. But, when you say no to so many people, you think there's got to be kind of a product or a service or something in that. You can't get rid of the entrepreneur in you. And then I bought a seminar business. And the seminar business was selling these seminars on marketing, on Facebook advertising, on all these kind of things. This was back in like 2008.
How has COVID affected you? Because for us, it actually helped us. People are way more comfortable doing deals via Zoom than ever before.
That was one big transformative thing. What was really funny, so we got our Zoom account in 2016. And actually at that time, we took a vote in our office because I've got like 17 people in an office in Singapore, or not in an office anymore. But in 2016, we actually had a vote on, would you prefer to work from home or carry on coming to the office? And it was overwhelmingly work from home. And so we actually switched our entire business model to working from home from 2016. We also got rid of holiday time. So there's no vacation time. If you want to go on vacation, just go. You just have to make sure all the work is done. So we have complete flexible working with the entire team. And so actually when COVID arrived, we were pretty well set up for it straight away. And like you say, doing deals over Zoom really, really improved. Although one thing I would say is that doing deals over Zoom in Europe and Australasia and Asia was fairly easy. I would actually say in the US it was a little bit harder. So in the US we noticed during the really harsh lockdown period, like 2020 time, complete drop off of transactions in the US. We were having plenty of calls, we were having plenty of conversations, but nothing was really closing. But we were closing deals like crazy in Europe. And they had exactly the same lockdowns and restrictions and all of that stuff. So